Hi, I'm David Stein of Money for the Rest of Us, and this is a channel on money, investing, and the economy. Today, we're looking at China. The Chinese stock market is down over double digits year to date. Some of the major ETF companies are dramatically cutting exposure. There's been a regulatory crackdown. It's been a really tough environment. Should we as investors stop investing in China? Should we be cutting our exposure? Has China gotten too risky? Let's take a look. Here's a quote by Cathie Wood. She's the chief executive at ARK Invest. She says, "We have not eliminated our positions, but we have reduced our positioning in China dramatically." They've cut exposure to some of the big tech companies, and they've added exposure to companies they feel like are currying favor of the Chinese government, that aren't necessarily in the Chinese government and regulators' sights, trying to disrupt their business models. The MSCI Emerging Markets Index, the China component, which makes up close to 40% of the index, is down double digits, while other Southeast nations, Taiwan, Vietnam, are up double digits. Some of the biggest companies in the world, Alibaba, which is the top chart, Tencent, which is the lower chart, are down significantly year to date. The Chinese stock market is relatively young. It was closed from 1950s until 1990, when some state-owned enterprises began raising capital. But even by the year 2000, just about 20 years ago, only 1% of Chinese stocks were non-state-owned companies. Private companies wanted to raise capital, and they looked to the offshore market, and they used what is known as a variable interest entity. What a VIE is the company registers in the Cayman Islands or some other location, and then they raise capital in the US. But it's an interesting structure because in China, there are restrictions on foreign ownership of companies, especially tech companies. And these tech companies would raise this outside capital, but the intellectual property had to be owned by individuals in China. And all there was a contractual agreement that the Chinese individuals would pass on the revenue and the income to this offshore entity. Now, the financial statements are consolidated for financial purposes, but these VIE entities really have no legal standing in China. The Chinese government sort of looks away, but in reality, the VIE was used to sort of skirt the Chinese regulations. We've seen a crackdown on this. Online tutoring companies in July were told by the Chinese government that they had to go nonprofit. These were publicly traded companies that had ADRs or stocks trading on the New York Stock Exchange. Those stocks fell well over 90% in just a matter of days because their business model was shot, because no longer could they be for-profit companies. And so China started cracking down on the VIE structure. Here's some other regulatory crackdowns and ideological campaigns in China. There's been restrictions on foreign IPOs. The Ant Group had to scrap their IPO last November. There's been anti-monopoly investigations. Just today, Ant Group was told by the Chinese government they had to spin off their loan subsidiary and give some control to the Chinese government and share some data. There's been new data privacy laws, new gig worker conditions. Tutoring companies that, as I've mentioned, had to go nonprofit. Private schools, this was reported by the Financial Times, have to become state-owned schools without any compensation at all. Firms and wealthy individuals have been told to increase their charitable donations. There's been new rules for online celebrity fan clubs, restrictions on those under 18 to be able to play online gaming. There's been blacklisting of actors and other entertainers who have incorrect views. School children have to take weekly classes to learn more about the Chinese premier and president of China. Now, these are all things going on in China. Has the Chinese stock market gotten cheap enough to justify that? This is from the monthly investment conditions and strategy report I do for Plus members. This might be a little more challenging to see, but the black diamonds represent the 10-year average forward price to earnings ratio of stocks in different countries. And so forward means it's based on forward-looking earnings, which those PEs tend to be a little lower than if we look at trailing 12-month earnings. The red dot is where we are today. Now, the Netherlands is the most expensive stock market in the world on a forward PE basis. The US, which is the largest stock market in the world, makes up close to 60% of the global stock market. Its forward PE is 22. It is much more expensive than average. But as you go down the list, China has a lower forward PE at 13.5, but it's still more expensive than its 10-year average. And so even though there's been all these crackdowns, China is not less expensive than its historical average. How do we invest in China or not invest in China? If you own the Vanguard Total Stock Market ETF, VT, it has only about 4% in China. But if you have exposure to VWO, the Vanguard FTSE Emerging Market ETF, that's about 37% in China. Now, I own both of these holdings. In fact, I own all 4 of these holdings. On Money for the Rest of Us Plus members are able to see all my holdings on my portfolio. Now, one of the things that we've done this year in our model portfolios is add some emerging markets exposure, but we've done it through the Wisdom Tree Emerging Markets High Dividend ETF, or DEM. That particular ETF is about 20% China. So it's a way to get exposure to emerging markets, very, very inexpensive emerging market companies that have very high dividend yields. That's the exposure that we've added, DEM. Also, earlier this year or late last year, I had exposure or added exposure to the Wasatch Emerging India Investor Fund. Now, this is actually a mutual fund, not an ETF. The ticker is WAINX. It's up over 30% year to date. Now, obviously, that doesn't have any Chinese exposure. I have a video on should we invest in India. I have a big India position because I think that country will be one of the fastest growing economies in the decades ahead. If you saw that earlier chart, though, it's not a cheap country in terms of its PE. And that's one reason I've used an active manager to be picking out stocks within India that they believe justify the high valuations. Now, the bottom line is I continue to own and have exposure to Chinese stocks. What is happening concerns me, but I also recognize that China is one of the largest economies in the world, and my overall exposure is less than 10% of my stock allocation, and as a percentage of my net worth, it'd be only a couple percent. So I'm willing to hold on, see how things evolve. The Chinese regulators say that they're not out to completely undermine the Chinese stock market. They're just making some tweaks, and these have been major, major things, but I'm willing to hold on. Now, you might want to pull back your exposure, particularly if you have exposure to some of these big Chinese technology stocks. But as I showed some examples of different ETFs you can hold, including emerging markets ETFs, DEM, that have a lower exposure to China, you continue to benefit from higher growth rates in emerging markets, but not taking such a big bet in China like you do with VWO. So that's our video on China. If you have any questions or comments, please leave those below. And hey, subscribe to my channel. Thanks.